Why is the United States at the very bottom of this chart? This is about the sources of return. And what you're looking at is one of the most dangerous regime shift signals investors ignore right before leadership changes. This exhibit shows year to date 2025 equity returns in US dollar terms and broken into four drivers: earnings per share contribution, then we have PE contribution, then we have dividend contribution, and then we have USD contribution, the currency effect. Then you have the income, valuation, and the earnings growth. The orange diamond at the top of each bar is the total USD return. I guess the question is, how much of, where do we get that return? Each vertical bar stacks these four drivers to show how that market made money, not just how much. And this distinction is everything, because markets that rise on earnings and currency tailwinds behave very differently than markets rising on valuation stretch alone. So let's look left to right. You have Spain, then you've got South Korea, then you've got Italy. As you know, as I'm talking to you, the returns are dropping, right? Then you have Europe, which is the stock 600, the UK, the FTSE 100, Switzerland, SMI, China, emerging markets, Japan, ex-Asia, and at the end, you've got the S&P 500 in local terms and US dollar terms. They all beat the S&P 500. And the last clause matters. This is not just weak dollar optics, it's real performance. And now, look how they are doing. The three return regime on this chart, three distinct market regime. Okay, one is the earnings-led market. Now, the reason I could tell you it's a earnings-led market is because you look at the tab. And the tab that we want to look at is the earnings per share contribution. That is very material. Looking at is the three regimes, okay? The first one is the earning-led market, the healthy markets. And by earnings, we're talking about earnings per share contribution. The dark blue part. Now, who's got, the earnings per share contribution? The healthy markets, you've got the KOSPI, the IBEX, and the MSCI partially. These markets show thick dark blue earnings per share blocks. IBEX, KOSPI. KOSPI is, let me make sure, that's South Korea. Okay. And of course, you're looking at MSCI EM, the emerging market. Then, next, you have what that means that basically profits are rising, margin stabilizing or expanding, and capital spending translating into cash flow. These are durable returns. Then you've got the currency-assisted markets, positional. DAX, Germany, the CAC 40, which is France, Europe, basically. And then you've got stock 600. Here, earnings are moderate, but the gray USD contribution is large. That's a currency-assisted market. Currency valuation, right? Because the dollar weakened against the euro. So obviously, they're making more money because the dollar is weakening. So their performance is, don't forget, this is all US dollar. This is all US dollar performance. So obviously, if the dollar is weakening against these currencies, I know it's a little bit complicated. I want to make it easy for you, but if the currency is weakening, the dollar is weakening against those currencies, obviously they're doing better. And you could see that there's lots of grays all over because the dollar has been weakening against lots of currencies, especially the CAC, the FTSE, the DAX in Germany, and all these countries. Okay, so you have dollar weakness, translation, capital rotating out of the US. That's what happened. A lot of the European got their money out of the US early last year because they didn't like the US anymore and because they felt that the dollar was going to get weakened. Why? Because the US government said we want a weak dollar. So they got out because they know that's going to impact their performance. Now, don't forget, once they bring the money back, it's the opposite. It's got the opposite impact. If you have euros investing in the US dollar market and the dollar weaken, once you bring it back into euros, you lost money. As much as 10% against the US against the euro. So even if you made 13% in the US, you actually made 3% once you bring your money back into euro. So that's not good. And 3, valuation dependent markets. Now comes all the way to the far right, the S&P 500. And the valuation dependent is to the right. And that's the S&P 500. Minimal earnings per share contribution compares to the others. I mean, look at the Kospi and look at the IBEX. It's a small amount. No currency help because it is the dollar. What's left? Well, there was a sliver of valuation support, which is the most fragile form of equity leadership, right? Because you're willing to spend so much and then you're not willing to spend any more money on the same amount of earnings. So why the S&P 500 is a red flag? Well, the S&P is not crashing. It just saw low quality returns. Earnings growth is narrow and concentrated. Index returns are dominated by a handful of mega caps, right? Margins are already elevated. Valuations are doing the heavy lifting. Historically, markets like this don't collapse first, they stall. They underperform quietly while global market migrates elsewhere. You could see when you look at the charts to the right, that little blue bar is all by itself. It doesn't get any kind of support beyond just the earnings per share contribution. It doesn't get PE contribution. It doesn't get dividend contribution. It doesn't get any contribution. It's just solely being held up by the earnings per share contribution of the S&P 500, which quite frankly, we're just talking about 7 stocks. So this chart is a result of 4 macro forces colliding. Peak U.S. profit margins, how much money can you make? Late cycle fiscal impulse, dollar rollover, i.e. the dollar is weakening, and rest of the world's earning catching up. They're making more money overseas. It's not anti-US, it's not anti-concentration, and global markets are telling you calmly and rationally that diversification is back. It is time to go and look for money somewhere else. And this is something that I tell my subscribers, and don't forget to subscribe to this channel, and particularly to my members, Patreon and YouTube, where I come to you every day in the morning between 8 and 9 telling you, okay, this is what's happening, this is what I'm doing. How to take advantage of that situation, which is changing, as we've seen last week, drastically. So what investors get wrong? Well, most investors will look at this chart and say, yeah, but the S&P is still up. But that's backward thinking. By the time the S&P underperforms loudly, the opportunity elsewhere is gone. This is not the early signal, not the headline event. This is not a crash chart. This is a leadership rotation chart. And leadership always changes before the narratives do, as I always say. You need to realize a few things. Try to buy when everybody else is selling. Sell, obviously, when everybody else is buying later on. And make sure that don't focus so much on the return. Focus on the risk. the risk, the black swan. That's what you need to focus on. And that's what we do in the channel with my members, trying to understand what the risk is. Because the market goes up, unfortunately, all that wave brings all the boats at the same time at the same height. But when it collapses, you don't want to be there. You want to be gone. That's the idea.